In this video, I'll be revealing the tax hack that makes RRSP withdrawal timing work for Canadian retirees. Through working with Canadian clients optimizing RRSP strategies, I've discovered that retirees who convert during artificially low income windows before CPP and OAS begin pay a fraction of the taxes compared to those who wait until government benefits stack income into high brackets. That's exactly why I'm making this video today, to show you the early retirement withdrawal window that enables moving RRSP money at the lowest possible rates, and how understanding this sequence transforms RRSP withdrawals from a scary tax bill into a strategic control move. Let's get right into it. Once you stop working, something interesting often happens from a tax perspective. There's usually a short, specific window early in your retirement where your taxable income drops meaningfully, sometimes more than people expect. For many Canadians, this window opens after employment income stops, but before government benefits fully begin. Most commonly, that's somewhere between age 60 and 65, and sometimes it extends closer to age 70, depending on decisions like when CPP and OAS start, which are themselves part of your broader retirement plan. During this period, several things often line up. Employment income has ended, CPP may not have started yet, OAS may not have started yet, RRSP minimum withdrawals do not yet apply, and the result is that your marginal tax rate can drop sharply, sometimes into brackets you haven't seen since your early career. It's not unusual for someone who paid 40 or 50% tax bracket at their highest marginal rate while they're working to find themselves temporarily in lower tax brackets like 20 or 30% range during these early retirement years. That drop is not permanent, and that's exactly why this window matters. When RRSP withdrawals happen here, you're often looking at tax rates that are 10 to 30 percentage points lower than what those same dollars could face later in retirement. So why does this low retirement income window prove so critical for RRSP optimization? Well, because once this window closes, you don't get it back. As CPP starts, taxable income rises. As OAS starts, income rises again. As RRSP minimums begin, withdrawals become mandatory. At that point, RRSP planning shifts from intentional to reactive. This is where many retirees look back and realize they missed the best opportunity. Not because they did anything wrong, but because no one ever showed them the sequencing. Understanding this window early doesn't mean everyone should rush to pull money out of RRSPs. It means you now know when the math can work in your favor, and when waiting quietly pushes you into higher lifetime taxes. The low income window creates opportunity. But once CPP and OAS and other income sources begin stacking together, the opportunity narrows fast. And that's where waiting too long can create the exact tax problem most retirees never saw coming. Now, the low income window enables tax efficient withdrawals, but understanding what happens if you wait reveals a costly mistake. This is where income stacking quietly starts to do damage. Stacking CPP and OAS with even moderate investment income from non-registered accounts can easily create a base taxable income in the $30,000 to $50,000 range. Now, layer on mandatory RRSP withdrawals and possible pension income, and suddenly a large portion of your income is being taxed at much higher marginal rates. This is the key issue. Income that could have been withdrawn earlier at lower, more manageable tax rates is now being forced out at higher rates simply because the timing window closed. And once total income crosses certain thresholds, OAS clawbacks begin. At that point, every additional dollar doesn't just face regular income tax, it also triggers an effective additional 15% tax through the OAS recovery tax, and right up until OAS is fully clawed back. So you're not just paying more tax, you're getting less value from every dollar you withdraw. And the problem doesn't improve with age. RRSP minimum percentages increase every year. CPP and OAS rise with inflation. Investment income often grows over time, depending on how your portfolio does, which means income stacking and the tax drag that comes with it tends to accelerate, not stabilize. This doesn't mean you will be okay, but it also means more paid to CRA, less flexibility, less left for legacy, and far less control over how and when income is taken. And once RRSP minimums and government benefits are fully in motion, there's very little you can do to unwind it. So this raises an important question. If income stacking and OAS clawbacks become a problem after mandatory withdrawals begin, what can be done before you get there while you still have control? That's where early intentional planning can make a meaningful difference. Once your income moves into the mid $90,000 range in today's dollars, OAS begins to be clawed back. And once you're well above that range, it can be fully eliminated. The important thing to understand is by the time mandatory RIF withdrawals start, you no longer control whether you're above that threshold. The withdrawals are required. The percentages are fixed and there's no opt-out. This is why waiting until age 72 to address the problem is usually too late. Where planning can help is earlier, typically in your 60s when RSP withdrawals are still optimal. CPP and OAS may not have started yet. Tax brackets are often lower, as we talked about earlier, and you can still decide how much income to recognize each year. For households approaching the OAS clawback range, strategic early withdrawals from your RSP can reduce future RIF balances, lower forced withdrawals later, and help keep total income below clawback thresholds, or at least reduce the severity. In practical terms, that can mean preserving $8,000 or more a year of OAS, plus avoiding the higher marginal tax rates on income that would otherwise be forced out later. When you multiply that over 20 or 30 years of retirement, the difference can easily add up to hundreds of thousands of dollars in after-tax value. And this isn't about eliminating OAS clawbacks in every case, and it's not for everyone. But for Canadians who've saved well and are unlikely to spend everything in their lifetime, early planning often preserves more after-tax income, more flexibility, and more control, rather than discovering too late that the system has already made the decision for you. Now that you understand the withdrawal hack, if you need more help with your retirement, click the link below to book a call where I'll analyze your specific situation and show you exactly how to optimize your Canadian retirement plan. Now let's look at future RIF reduction through strategic withdrawals. This is where early planning starts to pay off in a very concrete way. And before we go any further, let me be very clear about something. This is not about taking huge lump sums of your RSP. It's about strategically using up the lower tax brackets while you still have access to them. Every dollar you move out of an RSP before age 71 is one less dollar that will be subject to mandatory RIF withdrawals later. That's because once you reach your early 70s, the government doesn't just suggest how much income you take, it dictates the minimum, and those minimums increase every single year. When RRSP balances stay large all the way to mandatory RIF minimums, you end up with large RIFs. Large RIFs mean large forced withdrawals, and large forced withdrawals almost guarantee higher tax brackets for the rest of your retirement. Strategic withdrawals during your 60s can change that outcome. By intentionally withdrawing income from your RSP, only up to those lower tax brackets, you reduce the balance that future RIF minimums are calculated on. Smaller RIF balances mean lower required withdrawals, not just once, but every year for the rest of your life. And once you turn 65, this strategy often becomes even more efficient. Because at that point, it usually makes sense to shift at least a portion of the RSP into a RIF, even if it's just a partial conversion. Now, why would you do that? Because RIF income after the age of 65 is considered eligible pension income. That means two important things. First, if you don't already have a pension, RIF withdrawals can qualify for the pension income tax credit, which helps you get about $2,000 out effectively tax-free from your RSP or RIF. Second, and often more impactful, RIF income can be split with your spouse. Income splitting allows you to lower your household's marginal tax rate and creates more room in those lower tax brackets. That makes each dollar withdrawn more tax efficient than it would be coming out of a single RSP in one person's name. This is one of the most misunderstood parts of retirement planning. People assume deferring RSPs as long as possible is always the best because of the tax-deferred growth. But what they don't see is that deferral concentrates income later, right when CPP, OAS, maybe pensions, and investment income are stacking on top of each other. That timing virtually guarantees higher marginal rates. Early controlled withdrawals combined with partial RIF conversions restore flexibility. They allow you to decide when income is recognized. They allow you to use lower tax brackets while they still exist. And they allow you to smooth taxable income over decades instead of compressing it into your 70s and 80s. And even if you don't need that income to spend, the strategy still makes sense. Money withdrawn in lower tax brackets doesn't have to disappear. It can be reinvested by topping up your tax-free savings accounts or just placed into non-registered investment accounts where you maintain control and flexibility. So the goal isn't spending more, though it can be if that's what you're looking for. But the goal we're talking about here is controlling when tax is paid instead of letting mandatory rules decide for you. And over a long retirement, that difference can be enormous. Now, risk reduction prevents problems. And now that you understand why this matters, let's look at the comprehensive RSP withdrawal framework, how this actually gets implemented in real plans. So how does this actually get implemented in the real world? The first step is getting clear on where you are today. That means understanding your current income, your savings across accounts, your retirement timeline, and most importantly, your goals. How much do you want to spend? What kind of flexibility do you want? And whether leaving a legacy matters to you. From there, we need to identify whether you have a low income window. That window often shows up after you stop working, but before CPP and OAS or mandatory RIF withdrawals begin. For many people, that's somewhere in your early 60s through to your early 70s. Once we know whether that window exists, we look at CPP and OAS timing. And this is not a standalone decision. We're not asking, should you take CPP at 60, 65, or 70 in isolation? We're asking, how does the timing of CPP and OAS affect your tax brackets, your RSP and RIF withdrawals, and your total lifetime tax bill and sustainable spending? For example, if you delay CPP or OAS, that often creates more room in those lower tax brackets. That room can then be used to intentionally withdraw from your RSP or RIF during your 60s. On the flip side, if you take CPP or OAS earlier, we evaluate how that changes the amount of room available for RSP withdrawals, and whether it still makes sense to draw money out at manageable rates. Once that's optimized, from there, we build your plan for systematic withdrawals, not large lump sums. This is not about draining your RSP quickly. It's about intentionally using up lower tax brackets while they're available. For many clients, that means taking controlled withdrawals from RSPs or partial RIFs throughout their 60s. And once you're 65, using RIF income can be even more efficient because it qualifies as pension income. That allows for pension income splitting and the pension tax credit, which can further reduce household tax rates and create even more room in those lower tax brackets. If the money isn't needed for spending, it doesn't disappear. It gets reinvested by topping up tax-free savings accounts, or if that's already done, invested in non-registered accounts, creating more flexibility and control later in retirement. And once the plan is in place, it's not a set it and forget it strategy. You want to revisit this, and we always revisit this every year because markets change, spending changes, tax rules change, health changes. So by updating the plan annually, we can continue to optimize withdrawals, monitor RIF balances, watch the old age security clawback thresholds, and adjust before unintended tax consequences show up. For certain clients, especially those who save well and are unlikely to spend everything in their lifetime, we've seen the impact of this kind of planning reach well into six figures, and in some cases exceed $500,000 when you look at lifetime taxes, retirement spending, and estate values together. But this is not a one-size-fits-all strategy. There are absolutely scenarios where deferring withdrawals and preserving tax-deferred growth makes sense. And the only way to know which side of that line you're on is to go through proper retirement planning. That's where we're working with professionals who focus on retirement income and tax planning day in and day out to make a meaningful difference to your outcomes. Now that you understand the tax hack that makes RSP conversion work and how the artificially low income window, OAS clawback prevention, RIF reduction, and lifetime tax smoothing enable converting at a fraction of normal rates, you can implement a strategy that actually optimizes your Canadian retirement. If you want help executing your withdrawal strategy, click the link below to book a call where I'll walk through your specific situation and show you exactly how to optimize your retirement plan. And I'll see you in the next video.